This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to our daily roundup. We are diving into the biggest shifts in finance, tech, and global travel to keep you informed on the news driving the markets and your world today.
Hedge funds are paying massive fortunes to win top talent.
OpenAI loses 3 top executives while narrowing its focus.
Airlines cut summer routes as jet fuel costs spike.
World Cup fans face massive train fare hikes in Jersey.
Oil prices plummet as Iran opens the Strait of Hormuz.
Global markets surge on news of a Middle East de-escalation.
OnlyFans seeks a $3 billion valuation in stake sale.
Air New Zealand introduces triple-decker bunk beds for economy.
First, the hedge fund war. The hedge fund industry is undergoing a massive structural shift where the focus has moved from legendary individual traders to sprawling institutional platforms. In this $5 trillion landscape, the most important news isn't about a single brilliant trade anymore. It's about who is winning the talent war. Top portfolio managers are now commanding guaranteed 9-figure payouts and multi-year contracts that look more like deals for professional athletes than traditional finance roles. This intense competition for a finite pool of talent has forced firms to get creative, offering perks like relocation to tax havens such as Dubai or Puerto Rico. At the same time, the cost of these hires is so high that some firms are pivoting to develop talent in-house to avoid the astronomical fees associated with poaching stars from rivals.
It is fascinating to see how this talent scarcity is changing the actual culture within these firms. We are seeing recruiters push into ethical gray areas, using sophisticated spycraft to vet potential hires before committing to these $50 million deals. While many white-collar industries are seeing career ladders collapse, hedge funds are actually building them out to retain loyalty in an era of mercenaries. However, not everyone agrees the crisis is permanent. Paul Singer of Elliott Management has suggested that the talent war might be slightly exaggerated by a period of high fees and a good market. Regardless, the ripple effects are clear. New roles are being created that don't even involve managing money, and the industry is becoming more institutionalized than ever as it moves away from the era of the single-star genius.
Next, OpenAI's executive shakeup. OpenAI is facing a significant leadership transition as 3 top executives announced their departures this past Friday. Kevin Weil, who led scientific research, Bill Peebles, the head of the Sora video app, and Srinivas Narayanan, the CTO for B2B applications, are all moving on. This exodus comes at a critical time as the company tries to streamline its operations. Under the direction of applications CEO Fidji Simo, OpenAI is intentionally cutting back on what they call side quests to focus more heavily on selling to businesses and achieving profitability ahead of a potential IPO. For instance, the scientific research team is being decentralized, and the Sora project was recently shut down due to high costs and compute constraints. It is a clear signal that the era of experimental expansion is being replaced by a more disciplined corporate strategy.
This narrowing of focus is also a response to the intense pressure coming from competitors like Anthropic. While OpenAI is restructuring, Anthropic has been gaining significant traction with business-focused tools like Claude Code, which has sparked fears of a software-as-a-service apocalypse among traditional providers. Anthropic's valuation has reportedly surged to $800 billion, nearly matching OpenAI's recent valuation of $852 billion. The departure of Narayanan is particularly notable as he was a key figure in the B2B space, though his exit is reportedly for family reasons. As OpenAI unifies its business and product strategy, moving projects like the Prism Scientific Workplace into the Codex Developer Assistant, the company is betting that a more focused approach will help them maintain their lead in an increasingly crowded and well-funded artificial intelligence market.
Now to airline cuts. Travelers planning their summer vacations are facing a new hurdle as major airlines like Delta and Air Canada begin cutting routes in response to soaring jet fuel prices. The ongoing conflict involving Iran has caused oil prices to spike, which has a direct and pronounced impact on airline operating costs. Jet fuel typically accounts for up to 30% of an airline's total expenses, and prices have effectively doubled since the start of the war in late February. Because many tickets were pre-sold based on much lower fuel price expectations, airlines are finding that some long-haul routes are no longer profitable to fly. Rather than just adding surcharges to existing tickets, which can be legally complicated, carriers are opting to cancel flights entirely to avoid taking a massive loss on those specific routes.
The specific route cuts are quite broad, affecting both domestic and international travel. Delta is reducing service from major hubs like New York's JFK, Detroit, and Boston, with cancellations hitting destinations ranging from Memphis to Reykjavik, Iceland. Air Canada is also trimming its schedule between Toronto, Montreal, and New York. The head of the International Energy Agency, Fatih Birol, has warned that this is part of the largest energy crisis in history, noting that some European airports may only have a 6-week supply of fuel remaining. This creates a precarious situation for the summer travel season, as more cancellations could be on the horizon if supply chains don't stabilize. For passengers, this means less choice and potentially higher prices for the remaining seats, as the industry grapples with the reality of fuel costs that are simply unsustainable for their current schedules.
Next, the World Cup. Soccer fans heading to MetLife Stadium for the FIFA World Cup this summer are in for a massive shock when they see the price of public transportation. New Jersey Transit has announced that round-trip train tickets from Manhattan to the stadium will cost $150 per person on match days. To put that in perspective, the usual fare for that 9-mile trip is just $12.90. This massive hike has drawn sharp criticism from local leaders, including New Jersey Governor Mickey Sherrill, who pointed out that FIFA is expected to generate $11 billion from the tournament but isn't contributing a single dollar toward the local transportation costs. The state is currently facing a $48 million bill just to move fans safely, and officials claim the price hike is a necessary measure to recoup those expenses.
The logistics of the event are equally daunting. MetLife Stadium can hold over 78,000 fans, but NJ Transit is only making 40,000 train tickets available per match day. Since most on-site parking will be unavailable, the majority of fans will be forced to rely on these expensive trains or an $80 bus shuttle service. New York Governor Kathy Hochul has also weighed in, calling the $150 fare awfully high for such a short ride. Despite the backlash, New Jersey Transit maintains that this isn't price gouging, but a matter of survival for the agency's budget. Fans will have to purchase these tickets in advance, adding another layer of planning and expense to an already costly event. It highlights a growing tension between international sporting bodies and the local municipalities that have to foot the bill for the infrastructure required to host them.
Now, the oil market. In a major turn for the global economy, oil prices plummeted on Friday after Iran declared the Strait of Hormuz completely open for commercial vessels. This strategic waterway is responsible for the flow of about 1/5 of the world's crude oil, and its disruption during the recent conflict had sent energy prices soaring. The announcement came from Iran's foreign minister, who stated that the passage would remain open for the duration of the current ceasefire. This news provided a massive boost to global stock markets, with the FTSE 100 and other European indices ending the week on a high note. Analysts are calling this the perfect end to the week for bulls, as it signals a potential return to normality for global supply chains that have been under immense pressure for months.
The impact on the markets was immediate and dramatic. Brent crude, which had been trading near $98 a barrel, dropped sharply to around $89. While it will take some time to clear the backlog of tankers and repair damage caused by recent drone activity, the opening of the strait is seen as the most significant development since the ceasefire began. Interestingly, the drop in oil prices actually caused some energy-heavy indices like the FTSE 100 to underperform compared to their European peers, as shares in giants like BP and Shell took a hit. However, for the broader global economy, the prospect of lower energy costs and more stable shipping routes is a huge relief. It brightens the outlook for the rest of the year and offers hope that the worst of the energy crisis might be behind us.
More on oil prices. The collapse in oil prices on Friday was even more severe than initially expected, with some futures dropping by more than 10% in a single day. This extension of losses followed the formal announcement on social media by Iran's foreign minister, Abbas Araghchi, confirming that the Strait of Hormuz is fully open in line with the ceasefire in Lebanon. U.S. West Texas Intermediate crude fell by over $11 to settle around $83 a barrel. This de-escalation is being closely watched by analysts who are now waiting to see if the actual number of tankers crossing the strait increases substantially in the coming days. The market had already been leaning toward optimism due to rumors of further diplomatic talks between the US and Iran, but this official confirmation acted as a massive catalyst for the price drop.
Adding to the momentum, President Donald Trump confirmed the news on Truth Social, thanking Iran for the announcement. He also suggested that a broader deal with Tehran might be very close, mentioning that Iran has offered not to possess nuclear weapons for more than 20 years. This diplomatic progress, coupled with a 10-day ceasefire between Lebanon and Israel, has fueled investor hope that the wider Middle East conflict is finally drawing to a close. The combination of increased supply through the Strait and the potential for a long-term nuclear agreement has fundamentally shifted the risk premium in the oil market. While volatility remains, the shift from a war footing to a diplomatic one has provided the market with its most significant downward pressure on prices in months, offering a much-needed reprieve for global energy consumers.
Next, OnlyFans valuation. OnlyFans is currently in advanced talks to sell a minority stake to a US-based investor, a move that would value the UK-based adult content platform at over $3 billion. The firm in question is Architect Capital, a San Francisco investment firm with deep expertise in financial services. This specific expertise is a key driver for the deal, as OnlyFans is looking to offer banking products to its creators. Many of these creators have historically struggled to access traditional banking services due to the nature of their work and the stigma associated with the adult industry. By partnering with a firm that understands the financial sector, OnlyFans hopes to provide more stability and financial tools for its 4.6 million registered creators, who generated over $7 billion in payments last year alone.
The timing of this stake sale is also linked to the recent death of the company's owner, Leonid Radvinsky, who passed away last month. Offloading a minority stake of less than 20% is seen as a way to ensure the long-term stability of the business, while keeping control within the family trust that holds Radvinsky's shares. OnlyFans is an incredibly profitable enterprise, reporting a pre-tax profit of $684 million on revenues of $1.4 billion. Despite its massive success and 377 million fan accounts, the company has faced challenges in the past when trying to secure traditional investment or banking partnerships. This deal with Architect Capital could represent a significant step toward mainstream financial integration for a platform that has become synonymous with the modern creator economy and digital adult content.
Finally, economy bunk beds. Air New Zealand is set to revolutionize long-haul travel for budget-conscious passengers by introducing triple-decker bunk beds in economy class. Starting this November, the airline will offer Skynest sleep pods on its new Boeing 787-9 Dreamliners specifically for the marathon 16 to 18-hour flight between Auckland and New York. These pods represent the first time lie-flat beds will be available to economy and premium economy travelers. Instead of sitting upright for the entire journey, passengers can book a 4-hour stint in one of the 6 curtained berths. The cost for this luxury starts at about $291 on top of the regular ticket price. It is a bold attempt to solve the perennial problem of getting quality sleep in the back of the plane without paying for a business class seat.
However, these pods come with a very specific set of rules to ensure a pleasant experience for everyone. Because the bunks are arranged in a tight triple-stack layout, the airline has published strict etiquette notes. No snacking, no children, and absolutely no visitors. They are strictly for solo snoozes, and passengers are even required to change into special socks provided by the airline to keep the pods clean. The berths are 80 inches long but quite narrow, and the airline warns that accessing them requires a bit of physical agility, including crawling or climbing. At the end of the 4-hour session, passengers will be woken by a gentle change in lighting. While it might sound a bit cramped, for many travelers facing a nearly 20-hour flight, the chance to lie completely flat for a few hours is likely a dream come true.
That wraps up our daily briefing. Thank you for joining us for these top stories. Be sure to follow the show for your next daily update on the news that matters most.